Hi everyone, Keith Wilson here, spreading a wealth of information. Lately I'm hearing a lot of talk about investing in small cap stocks or small cap funds. So what I want to do today is share with you, number one, what is a small cap, the historical performance, the risks involved, and when small caps tend to be better than large caps. So first of all, what is a small cap? You may have heard of, large caps, mid caps, small caps, but what does that word cap stands for? So the word cap stands for capitalization. So to be considered a small cap, then the market capitalization of that company's stock is going to be in between 300 million and 2 billion. So this is how it's calculated. All you do, you take the number of shares outstanding of that company times the share price of that stock. For example, if the company's outstanding share is 50 million and the share price is $10, then the market capitalization of that stock would be 500 million. That would put it into a category of a small cap. One of the most popular indices that tracks small caps is the Russell 2000. Now, keep in mind, you cannot invest directly in an index, but you could invest in funds or ETFs that mimics that index. Here's a lot of the attraction of investing in small caps, and that is they got great potential for high returns versus the larger companies. Historically, small caps have outperformed the larger companies dating back to 1979. So when we look at that chart, sure, yes, since 1979, small caps have outperformed large caps, but in certain time periods, large caps, they outperform. For example, according to Magnify Money, in the year ending December 2018, small caps would have lost more than 11% compared to large caps at a 6.24% loss. Hey, but in the previous 20 years, small caps returned 8.91% versus 5.97% for large caps. So, as you can see, small caps, they're going to tend to be more volatile, but man, when they're on, they are really on. So you can see the risk involved. Hey, it can be really large, and investors, they're going to have to be willing to accept those risks in order, to achieve the potential return. Here are some characteristics of small caps, and they would be they're more aggressive, they got aggressive growth, but they're higher volatility, and they are less likely to have dividends. There are certain risks involved with small caps, and they would be that they simply don't have the same resources as large caps, and they may not be able to survive an unexpected crisis. Also, they can't borrow money as easily as, big companies, and therefore, they got a greater risk of going bankrupt during a crash. However, there are times when small caps, they really shine. Small companies, what happens is they begin to rebound faster than large companies when the economy is growing and that recovery phase of the cycle is happening. So, following a recession historically, small caps can really respond quicker and they have much greater potential to grow faster than large caps. In the end, small caps, they can add some diversification to the portfolio, but here's the thing, I would say limit your exposure according to your risk tolerance. All right, so how much exposure should you have? I would say maybe 5 or 10%, but not something like 50% in my opinion. I believe it's fundamental to have a mix of both large, mid, and small caps, along with other types of investments. Hey, if you'd like to see more videos like this, be sure to hit that subscribe button below. I would really appreciate it. And remember to be wise with your money.